Welcome to the It's Your Smarter Money Show, where you will learn well to live well. Discover investing and financial planning strategies, ways to live your best life, insights from engaging experts, and much more. Now, please welcome your hosts.
Welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. It was the best of times. It was the worst of times. It was the age of wisdom and it was the age of foolishness. Does that Charles Dickens seem to describe our current world? Well, we were discussing this the other day at our team dinner. And when we look at our politics, our values, our lives, our overall situation all across the world, we can see that division everywhere. But did you realize that that division also does not escape the U.S. large cap stock market? We also see that market division in our investing world. And we see it when we talk about large cap versus small cap. And we even see it embedded in the large cap asset class. Yeah. And so Steve and I wanted to actually talk about that aspect of what's going on in the overall. And when we talk about large cap, again, we're talking about the S&P 500, right, because that's what everybody looks at. It's an index. Some people actually invest in that index. We tend to steer somewhat away from it. We include some of it. Yeah. But that's really what people are looking at right now. Right?
What's interesting is, 30, 40 years ago, people looked at the Dow. Hardly anybody looks at that.
That's right.
Longer, it's about, I think it's still 30 stocks. Mm-hmm. So it does sort of track the S&P, but I think the S&P is much more representative of.
Well, it's only 30 stocks, right?
Exactly. Much more representative of the market in general.
Mm-hmm.
Yeah. And also, by the way, the S&P actually just includes some mid-cap stocks.
Right. No small cap, though.
No small.
Which is kind of interesting because the small cap part of the market seems to have been lost over the past year or so.
Yes, it has. Although we've actually, our small cap asset class has performed pretty well over the last 3 or 4 years, but you're right. Mm-hmm. And it's very interesting that the large caps have been outperforming the small cap stocks for a while, I think, actually, if you look back at it, a couple of years, I think. Yeah. Well, we know the reason for that, and we'll talk about it, right?
Right. Well, and we want to focus on large cap today, Steve, and we could go on forever. We don't want to make everyone crazy here. This isn't a 3-hour class, but we wanted to talk firstly just about the overall division, because what we're looking at in terms of the market is that there are about, call it 4, call it 5, call it 7 magnificent, call it 10. I'm not exactly sure. The players keep jockeying around.
There's some rotation there.
Right. Yeah. But there are, let's just say, 10 primary stocks that have driven the S&P return. We actually were looking at that. It's 70% of the overall return year to date in 2024. Yes. And this is mid-year because it's the end of June. Yep. We're seeing that 10 of the stocks are performing. 490 not so much. They're all performing less than 5%.
And there's a technical term for that. It's called the breadth of the market. In other words, what percentage of the S&P stocks are actually performing well and what percent are not. Now, the other interesting thing about this is that right now, the S&P is about 35% in those 10 stocks. It's more concentrated than almost it's ever been in history, which is kind of a scary circumstance, because if those stocks don't perform well, you could see an increased volatility with the S&P 500 index.
Well, and it shows. They call this a bifurcated market. Right. Also, is another term that you may have heard them use. And the idea behind this is that while people do have a lot of optimism around these primary stocks, there's a whole bunch of stocks that are not necessarily seeing that, and we see that also. We were talking about drawdown. And oftentimes we want to look at drawdown in terms of the volatility of the market. How far have any of the indexes fallen, whether it's the S&P, the NASDAQ, the Russell 2000, whichever index you're looking at. And while the overall markets don't appear to have that kind of high drawdown, when we look at the average drawdown across the stocks, there's much more volatility within the overall index.
That's correct.
which so there are a lot of people that think that everything's just hunky-dory and they're just focused on that high level S&P index. And it's important to understand that while we're still optimistic and we still want to see the market continue to perform,
Certainly.
we have caution.
Yeah. And I want to mention another measure that's important to look at. It's called the advanced decline line. And that's actually a good measure of the breadth of the market. So the way it's calculated is you take the number of stocks that went up in a day, deduct from it the number of stocks that declined, and add to it the previous day's advanced decline line. And if you show the graph of it now, typically in a strong market, you'll see the advanced decline line increasing in conjunction with the index itself. But right now we see the index skyrocketing and the advanced decline line is flat, if not slightly declining.
Right. So in common language, more people are selling than buying,
That's right.
which is something that we have to consider. It really is a consumer sentiment type of metric, right?
Well, it sort of is, yeah, because you're saying, all right, what percentage of stocks are going up in relation to what percentage are either not going up or actually declining in price. So I will mention that we're not completely in the S&P 500, as you mentioned, and I'm not so sure that we're going to get hit as hard in a decline as the S&P itself may get hit.
So we're in those stocks.
We are.
We're just not in the same relationship. We don't have as much of those top 10 stocks.
Right.
We're kind of staying away from that. Those top 10 stocks have a PE ratio of somewhere around 28%, which is very high.
It is very high.
The S&P 500 has a PE ratio of 20.5, I think, right, as of recently. And the 490 stocks have something in the relationship of a PE ratio of 17. And we even tend to play in the lower arena of those 490 stocks. We tend to go even further down, 13, 14.
About 13, yeah, exactly. And part of it's because of one of the holdings we have, the symbol COWZ. And that has a really low price to earnings ratio. It's around 7 or 8 last I looked. Very low.
Well, it's 100% focused on value, right?
That's correct.
I mean, because
a different definition of value, which is important.
Well, the valuation that we learned when we both got our MBAs,
right,
which is cash is king, and you need to focus on the cash that a business is producing. And by the way, I don't think those 10 stocks have any kind of representation in CowZ.
I don't think so either.
If I have to go back and look, I know that a couple of the top ones are not even represented in that in that way of looking at the S&P. But it's completely focused on cash. And when we look at the value stocks, we see that I don't know if you notice that the value stocks have never been so cheap.
No, they haven't.
I mean, 2000, maybe the value stocks were this cheap.
And we even have a chart here we've looked at, and it shows you the relationship of growth versus value and their valuations. And it's been years since value stocks were this cheap. And in that graph, I don't think it ever shows that they were this cheap. You're right. It's a good point.
Yet, the history has shown us that over the past 100 years, value has outperformed growth.
Yes, that's correct.
Over and over again.
I think 60 to 70% of the time, I think of the numbers we have, 78% of the time over 10 years. But I will say this, there can be very lengthy periods in which one style can outperform another, which means that it behooves us to be patient. Patience is really, I think, one of the primary factors you need to have when you invest.
Yes, patience. Magic word. Yes,
patience.
Yes. So, and the thing with value also is don't sit and wait on the sidelines for the bell to go off because you're going to miss it. Value has tended to have wild swings in terms of, when it's now in play, it's already happened. When you notice it's performing,
it's too late.
Right.
Yeah. Well, we've seen it even with straight normal market recoveries. We saw that in 08. Now I'm straying a little bit from value versus growth here, but when in 08, the market was down. I remember March of 09, it hit its bottom. And within the next 2 or 3 months, it was up 25%. So if you tried to time the market and you missed that first couple of months of performance, you're never getting that back. That money's gone forever. So you've got to be patient. You may have to write things down at times because you know there's going to be a better day, and you have to wait for that better day. And you don't know when it's going to occur. And if you miss it, you could be in big trouble.
But over the long run, this is all over the long run. This is the way you're
Yeah.
going to actually see your portfolio perform.
That's right.
If you're looking at your performance the first half of this year, you might be a little bit unimpressed,
Right.
because
Right.
you're looking at a performance that is just lagging behind these top growth stocks.
That's right.
But we want to caution you from making the rapid. So one of the biggest problems that people have, we know behavioral finance is about chasing returns,
Right.
and moving. Now's not, even if somebody was able to convince us that we should have or could have been a little bit more weighted towards growth.
Yeah.
Now's not the time to make that decision.
No.
The decision should have been made a long time ago.
2, 3, 4, 5, maybe even 10 years ago.
Right.
Honestly.
Because you don't want to be making these kind of switches. And you've hired us to help you define a strategy that is long lasting and will benefit you over the long term. And that's what we're trying to do.
That's right. Yeah. And also, by the way, everybody's jumping on a NVIDIA bandwagon, but people are jumping on the Tesla bandwagon a year or two ago, and Tesla's not performing well, and that's not unusual for a stock that performs extremely well, that in the next year or two, its performance lags. We've seen that. And there's been studies that show that.
So NVIDIA, I always hesitate to talk about individual stocks,
Same here.
But it is a stock that has just been I guess going against all odds. And it has performed year to date somewhere around, depending upon what day I'm looking at it, almost 150%.
Yeah.
And so if you put $100,000 in NVIDIA, you would have what? 250, right? Yeah. And so somebody might be saying, well, okay, that we missed that. But I do want to remind you that NVIDIA was down in 2022 by somewhere, I think it was 65 or 68%.
It was 60 to 70 range.
So NVIDIA has the potential of swinging wildly. And so the thing is, when you have that kind of growth, and then you actually now the market goes down by 65, 68%.
Right.
I mean, you're going to be close to the start or even less. What we've seen oftentimes is that the high volatility up also creates a whole a downward slide, and you wind up even in a worse place than you were from the beginning. And that's assuming that you started out in the year. I think I still know some people that just recently decided last month to buy NVIDIA on its way up. And I'm concerned about them. We don't have a crystal ball. So
well, I think the other thing too is to keep in mind when a stock reaches high levels of valuation, even one bad analyst report could knock 10 or 15 or 20% off of its value literally in a month. And so you have to watch, because stocks, when they have that high valuation, they become riskier. They become more volatile. And one bad earnings report, and guess what? Suddenly now you lost 40, 50%.
They're all swinging from the trees.
Yeah,
they're all swinging from the trees. And,
yeah,
they might continue to go up. But we do know that nothing grows to the sky. We know that at some point, it's not necessarily going to go in that direction. And so we consider that more of a gambling or a speculative type of way of investing, because it's really looking forward to some kind of future earnings that we don't know if they're going to materialize. When we're focused on stocks that are producing cash flow, they're producing revenue, they're producing dividends, they're producing, they're actually proven. It's more of an investing type of role that a lot of our favorite investors over the course of their lifetimes, people like Buffett and so forth, have that kind of approach to investing.
They're very patient. And by the way, we'll probably do it in another video we're going to do soon. It's surprisingly how few numbers of stocks in the stock market actually lead to the stock market's return in the long run. And it's so few, it's very hard to decide, all right, which ones are going to be the winners, which is why you have that index.
Well, they're shocking, right?
That's right.
So it's a little bit of a different people. Different. We were just talking about when we were talking to Christina, and she was talking about it. Her father used to work for Kodak.
Right, Kodak.
I owned Kodak back.
I did too.
Until it was clear that
it got wiped out by digital.
Right. So, but at one point, it was one of the darlings.
It was.
So,
the Nifty 50. Remember the Nifty 50?
Yes, I remember.
We're old enough to remember that. It was from the 70s, I think.
Right. And I do want to mention too that while every situation is different,
right.
This is feeling a little bit like the late 1990s,
yes,
where we had this whole tech boom. And I hear people saying, well, those were stocks that really weren't producing revenue. I mean, they were top stocks in the S&P 500. Microsoft was one of the top stocks.
Yes, it was.
Intel. So Microsoft, Intel, Cisco.
Yep.
Well, I actually wrote it down. GE and Exxon. I
was going to say that.
And Exxon. Those were the top 5 stocks driving the market in 1999.
Yep.
In 2000, 2001, 2002, all of them lost in the 60s, 62%, 68%. A lot of them lost. Now, the only one that actually came back in any short period of time was Exxon. Exxon. Microsoft didn't come back to 2014,
yeah,
Steve.
That's right.
Recently. So even Microsoft, if you sat there, if you had the patience to sit there for 14 years, it started coming back in 2014. Cisco and Intel started coming back a couple of years ago.
They were flat for years.
GE.
And look what happened to GE. So that's the point there. The point you bring up, which is a great point, is that rather than trying to choose the winners and decide who's going to be the winner, you're better off being broadly diversified.
Right.
That's the key.
And I think most people understand that principle, like don't bet, and which is why people bet on the index. Well, but what people don't understand is that the index has gotten so distorted.
It is distorted.
That they don't realize the amount of exposure they have in these top 10 stocks. Even the top 5 stocks year to date, their contribution has been 55% of the overall return.
Yeah.
So even that, and we can name those top 5 stocks. It's Nvidia, it's Microsoft, Google, Meta, Amazon.
Yeah, I don't have the whole list, but what happens is when you have an index like the S&P, I think it's more susceptible to the behavioral characteristics that influence the market, and that's clearly evident in the S&P 500 right now because of the way those 10 stocks are performing. So you want to really try to move away from things that are affected by behavioral aspects, and the S&P 500, because its capitalization weighted, clearly is. Yeah. So
Steve and I have talked about this whole idea of behavioral finance and how people are watching the television set and they're watching that one index, the S&P 500, and then they're looking at their portfolio. And we just want to caution you, we are very aware of what's going on. We're not oblivious to what's going on.
Right.
We know that our large cap portion of our portfolio currently, not always and not usually even necessarily, is not performing like the S&P 500. But we are aware that a value tilt is not performing like some of these growth stocks.
Right.
We want to caution you, if you're thinking of ditching the current strategy, it's not usually a wise decision to take a strategy when you're that invested in it and move into another strategy that has already shined and outperformed, because the chance of, even though momentum does continue for a certain amount of time.
It's certainly characteristic in the market is momentum. And that's actually, there's another term actually, I'm not going to get too techie here, but it's called serial correlation.
Yeah.
In other words, the performance of the market this month is somewhat correlated to its performance last month. And so that's another term for momentum. And we clearly see momentum in the market. Yeah, clearly.
Right.
Yeah.
And until it stops.
Exactly. And I think that's driven mostly by the behavior of traders and investors.
Yeah. Something usually ticks it off, and it just kind of is a domino effect. And before you know it, You have a down day of October 2008. I'll never forget that one day. Or
I remember vividly. I was in Italy.
Oh, were you? Okay.
Yeah.
Okay.
That month.
So we're still committed to value stocks. We're committed in our portfolio.
Yes.
We're committed in your portfolio. We think that it is the right place to be in the long run. We do think that we might see hopefully some closure of that gap between the higher performing stocks and the lower performing stocks, but time will tell. There's going to be hopefully a closing of the gap in the upward and not in the downward.
And I was actually going to say that, because sometimes you might see the closing of the gap because of a decline. And we did see it in 2020. Our holdings went down 2020. Yeah. Our holdings went down less than the market as a whole.
Oh,
yeah. A lot less.
And 2022.
Thank you.
And in many other, even go back to 2008, which I was just mentioning. But so we believe our job is firstly to help you define what your strategy is going to be so that you can meet your goals, you can meet your cash needs, and you can do it with less risk.
Exactly.
We spend a lot of time creating portfolios that will produce less risk over the long run. So that's first. We're then making security selections, looking for lower expenses, reducing taxes, reducing turnover, making sure that that's all working properly.
Right.
And then we are making sure the diversification, the asset allocation, really, really key.
By asset class.
Right. Which is also not necessarily relatively behaving as well as those top.
Well, asset allocation is the right strategy, but it may not work over a year or two, or, even 3 to 5 years. But when you start to go out to longer periods of time, it clearly works.
Absolutely.
Clearly works.
Right.
So.
And all the experts are saying, look, we have a lot of things going on. Yep. This is not the time to throw away asset allocation. It is still very, very important to invest globally, internationally, and also to spread your risk, even in things like real estate, which do have and other tangible assets that have a role, especially when we see inflation.
That's right.
So, we still believe, it's for 30 years, but that we've been investing, but it's also been shown empirically. So we still believe in the way we're approaching this. And we also want to remind you that our final, really, really most important role in your life is to make sure that you stay disciplined.
Exactly.
Make sure stay disciplined. Make sure you stay disciplined. Stick with the strategy. Do not bounce around from one strategy to another strategy. It's tantamount to selling high and buying low, and you're going to get yourself into a lot of trouble.
And if you have concerns, give us a call and we'll sit down with you and go over it in more detail too. We're happy to anytime.
Absolutely. But everybody's safe and everybody's safe. So we're not necessarily performing in some of the high highs, but we feel very, very comfortable with where we're at.
Right.
And we hope that we're able to help you feel comfortable as well.
Yep.
So as always, thank you so much for listening to us. Please give us a call. As Steve mentioned, we're happy to spend individual time with anybody that has questions about what we're doing.
Yep.
Thank you. And until next time.
Okay.
Thanks for listening to the It's Your Smarter Money Show. If you found this episode valuable, please like and subscribe to our channel. Until next time, learn well, live well, since, after all, it's your smarter money. Thanks for tuning in, and we'll catch you in the next episode.